Welcome to the Complete Guide to Money Creation. This video explores the mechanics of physical printing, the role of central banks, and the emerging digital future of currency.
The total money supply is quantified by metrics like M2 supply and the monetary base. Today, digital ledgers account for over 90% of all currency,
highlighting digital dominance
in
in finance. Physical currency is created by institutions like the Bureau of Engraving and Printing. They use specialized methods like dry intaglio printing on cotton linen paper and incorporate security features to prevent counterfeiting. The Reserve Bank of India manages the precision at scale required for the Indian rupee. Its banknotes use a cotton and linen blend, integrating high-tech security features and rigorous quality checks for nationwide distribution. Central banks ensure banknote fitness through automated screening for wear and tear and use sustainable cycles to replace unfit notes with newly minted currency. This process is crucial for maintaining public confidence. The Federal Reserve primarily creates new money digitally through open market operations. This involves purchasing treasury bonds from commercial banks, which digitally credits their reserve accounts. Selling bonds is used to absorb cash and slow the economy. Commercial banks expand the money supply through the multiplier effect, issuing loans based on a fraction of deposits. For example, a 10% reserve requirement allows an initial $100 to expand up to $1,000 in liquidity. Central banks control bank lending using the interest on reserve balances, or IORB. A high IORB incentivizes banks to hold funds, while a low IORB makes private lending more attractive, expanding the money supply. Seigniorage is the profit generated by issuing currency, where the purchasing power far exceeds the low production cost. This margin is significant, although it typically accounts for a small percentage of a developed nation's GDP. The inflation tax represents a social cost, where rapid money creation erodes purchasing power. The tax formula links revenue to the money growth rate, and high seigniorage reliance can correlate with macroeconomic instability. Modern monetary theory, or MMT, offers a paradigm shift in understanding fiscal sovereignty. MMT posits that a sovereign government issuing non-convertible currency cannot become insolvent, as it can print what it needs. The primary constraint is inflation, and taxes are used to reduce aggregate demand, not to fund the treasury. Applying MMT in developing countries is complicated by factors like heavy foreign debt, which restricts monetary sovereignty. Weak tax enforcement also makes it difficult to control inflation, posing high risks as seen in some case studies. The future of money involves central bank digital currencies, or CBDCs, representing digital money 2.0. CBDCs come in different formats, including wholesale for interbank settlements, retail for consumer transactions, and programmable formats that enable automated taxation and smart contracts. Comparing CBDC models, the direct model gives the central bank all operations. The hybrid model uses private banks for accounts and compliance, but the central bank remains liable. The indirect model relies on intermediaries for liability and private banks to issue tokens. CBDCs threaten traditional banking. They create fierce competition for deposits and reserves. This leads to fee erosion and infrastructure shifts, risking rapid digital bank runs as customers can withdraw funds instantly. In summary, we have covered physical currency and public trust, centralized digital reserves, MMT and fiscal sovereignty, and the future of money with CBDC tokenization. Thank you for watching this video. Here are the image sources used in this video. This slide continues the list of image sources.